The financial world runs on patterns most investors never see. Right now, as you read this, a cycle that began 60 years ago is playing out again with uncanny precision. If you know where to look, if you understand the rhythm beneath the chaos, you can see the same story unfolding that we witnessed in 1962. And just like then, most people won't realize what's happening until it's too late. This isn't about mysticism or fortune-telling. This is about documented mathematical cycles that have repeated through American market history with remarkable consistency. Research analysts examining decades of data have discovered something extraordinary. When they overlay the stock market chart from 1962 onto the market starting in January 2022, the patterns align with what they describe as remarkable similarity. The peaks line up. The valleys mirror each other. Even the timing of rallies and declines follows the same trajectory, separated by exactly 60 years. The economist Carl Juglar identified recurring cycles in markets as far back as 1862. He documented an 8 to 11-year rhythm of expansion and contraction that still appears in modern market data. His work established that markets aren't random systems, but rather follow predictable phases of human and economic behavior. But it was a trader named William Delbert Gann who took cycle theory to its ultimate expression. Working in the early 20th century, Gann spent decades analyzing market movements and discovered what he called master time periods. Among these, he identified the 60-year cycle as what he termed the greatest and most important cycle of all. Gann's research suggested that market movements unfold in rhythmic, repeating patterns tied to both human psychology and natural law. He identified several master cycles, notably the 100-year, 90-year, 60-year, 52-year, 45-year, and 30-year cycles. At any given time, one or more of these cycles, as well as divisions of these cycles, tend to influence the prevailing market trend. His methods allowed him to issue forecasts that have held up over time with documented accuracy. For example, 90 years back from the 1929 market, top takes us to the end of the 1839 speculative boom, which ended in the Panic of 1839. Counting 90 years forward from 1929 brings us within months of the COVID top in 2020, an equally significant inflection point. But the 60-year cycle holds special significance because it represents what Gann called the Great Cycle. This cycle, he wrote, repeats every 60 years or at the end of the third 20-year cycle. He pointed to the war period from 1861 to 1869 and the panic that followed 1869, then noted that 60 years later came 1921 to 1929, the greatest bull market in history, followed by the greatest panic in history. This, he said, proves the accuracy and value of this great time period. The math behind why 60 years matters connects to generational patterns. Physicist Tesaleno de Vezas advanced a causal model for long-wave phenomena based on a generation learning model. His research presented not only an explanation for the existence of these waves, but also for the first time, an explanation for the timing. A complete cycle spans approximately 60 years, which equals 2 generations. The patterns repeat because the economic lessons learned by one generation fade as a new generation rises to positions of power, making the same mistakes their grandparents made, but which their parents only heard about in stories. Dutch economists Jacob van Gelderen and Salomon de Wolf had previously argued for the existence of 50 to 60-year cycles in 1913 and 1924, respectively. The Russian economist Nikolai Kondratiev published his work on major economic cycles in 1925, identifying long waves in Western countries of approximately 50 to 60 years. Each cycle consists of 3 phases: expansion, stagnation, and recession. In his theory, a new cycle arises from the ashes of the previous cycle, and the process repeats itself. So what happened 60 years ago that might tell us what's coming now? To understand 2025, we need to examine 1965, but more importantly, we need to understand the crisis that defined 1962, because that's where the current cycle truly began. The year 1961 ended with the stock market at record highs. President John F. Kennedy had taken office promising continued economic expansion. Stock prices had been on a steady climb since the late 1940s. The economy was experiencing rapid growth. From February 1951 to December 1959, real GDP in the United States had risen significantly. When Kennedy took office, confidence was high. Everyone believed the recovery would continue. Then December 1961 arrived and the market peaked. What followed became known as the Kennedy slide of 1962, though some called it the flash crash of 1962. From December 1961 through June 1962, the market plummeted. During this period, the S&P 500 declined 22.5%. The Dow Jones Industrial Average fell 5.7% in a single day on May 28, 1962, at that time the second largest point decline on record. When comparing the highest and lowest points of the stock market during the Kennedy slide, paper values of stocks declined 27%. The parallels to 2022 are striking. That year also began with the market at record highs. The S&P 500 peaked on January 3, 2022 at a close of 4,796. Then came the decline. In the first 6 months of 2022, the S&P 500 fell 21%, the worst 6-month start to a year since 1970. By October 2022, the index had declined 25% from its peak. The Nasdaq Composite fell 33% for the year. On September 13, 2022, the S&P 500 declined by 4.32% in its largest single-day drop since June 2020. The causes in both eras show remarkable similarity. In 1962, the Federal Reserve had been tightening monetary policy. Interest rates climbed as officials tried to cool what they saw as dangerous speculation. The nominal GDP growth rate had been accelerating significantly in 1961, with growth going from only 0.5% year-over-year in the first quarter of 1961 to 9% year-over-year in the first quarter of 1962. This reflected massive monetary expansion. But from early 1962, a monetary contraction took place, and nominal GDP growth started to slow significantly. This was the real reason for what became known as the Kennedy slide. The geopolitical crisis of the Cuban Missile Crisis that followed in October was actually secondary to the monetary policy shift that had already begun months earlier. In 2022, the story rhymed perfectly. Throughout 2021, many central banks had maintained a zero interest rate policy, assuming the rise in inflation would be temporary or transitory. When inflation readings came in much higher and stickier than expected, central banks rapidly tightened policy. The Federal Reserve began raising interest rates in March 2022 to make borrowing more expensive and slow economic activity. This strategy was designed to ease pricing pressures and reduce the inflation rate. The headline Consumer Price Index reached a 40-year high of 9.1% in June 2022. From March 2022 through May 2023, the Fed implemented 10 interest rate hikes, taking the federal funds rate from near zero to a range of 5 to 5.25%. It was the second quickest monetary tightening cycle in recent history. On June 15, 2022, the Federal Reserve increased interest rates by 75 basis points, the biggest rate hike since 1994. On September 21, 2022, they raised rates again by 0.75 percentage point for a third consecutive time. The market reaction was severe. Throughout 2022, there was no place to hide as central banks rapidly tightened monetary policy. The S&P 500 returned negative 19.4% for the year, its worst annual return since 2008. The bond market experienced its worst year since 1976. The Bloomberg U.S. bond aggregate produced a BITSITO's negative 13% total return during 2022. Its biggest negative total return since tracking began in 1976. The decline was due to the highest inflation readings as part of the 2021 through 2023 inflation surge and the resulting increases in interest rates, combined with the worst year for the bond market since 1994. There were fears of a global recession due to declining economic indicators and an inverted yield curve. But just as in 1962, the market didn't simply collapse and die. After the Cuban Missile Crisis ended in October 1962, the market experienced sustained recovery. The resolution of the crisis was followed by a strong rebound in U.S. markets. A stable rise occurred throughout the remainder of the decade. Similarly, the rate of inflation peaked in late 2022 and declined thereafter. Economic growth accelerated in the second half of 2022, ending fears of a recession and leading to a rebound in stock prices starting in late 2022. The end of the stock market decline was also aided by the start of the AI boom, predictions of lower or stable interest rates, and predictions of a soft landing. By 2023 and 2024, many stock market indices reached all-time highs. The psychological patterns mirror each other across the 60-year span. In 1962, during the time of the Kennedy slide, the head of the American Stock Exchange, Edwin Posner, explained to reporters that this definitely is not panic selling. Instead, he attributed the drop in stock prices as an adjustment from the previous 10 years of increases. With this drop, Posner believed that stocks were reaching their realistic levels. The same narrative emerged in 2022. Analysts described the decline as a healthy correction after the massive gains of the prior decade. Valuations, they said, had gotten ahead of fundamentals. The market was simply resetting to more reasonable levels. Even the recovery patterns align. In 1962, the market didn't experience a stable recovery until after the end of the Cuban Missile Crisis in October. From that point forward, stocks climbed steadily. In 2022, the market bottomed in October, then began a rally that carried through 2023 and into 2024. The timing is almost exact. Both markets found their lows in October, then launched into sustained bull markets that would last for years. The 60-year cycle isn't just about stock prices. It shows up in broader economic patterns, cultural trends, and the rhythm of generational change. Themes in society often repeat every 60 years. You can observe this in fashion, art, music, and many other areas of life. 60 years ago, automation made significant progress in society. Today, we're seeing the next step in automation through artificial intelligence. The pattern isn't identical, but it rhymes. The technology changes, but the human response to opportunity and risk remains constant. The cycle also appears in political and geopolitical patterns. 60 years before the Cuban Missile Crisis, the world was navigating different but equally tense international conflicts. 60 years before Kennedy's administration, different leaders faced remarkably similar choices about monetary policy, government spending, and economic management. The names change, the technology evolves, but the fundamental dynamics of human behavior in markets and society follow predictable rhythms. Researchers examining this phenomenon note that while cycles can invert or distort temporarily, they consistently identify key inflection points and general directional bias. When analysts overlay the S&P 500 from 1962 onto today's market starting in January 2022, they see patterns that align with remarkable similarity. The first decline from the peak, the secondary test of the lows, the sharp rally that follows, the consolidation periods, even the magnitude of moves shows surprising correlation when adjusted for the different scale of the modern market. Because sentiment moves in waves, the emotional extremes of fear and greed remain timeless. While technology, policy, and liquidity conditions evolve, the human response to opportunity and risk does not. Even if equities rise in 2025 on optimism surrounding AI, investor psychology mirrors that of prior generations, driven by the same patterns of exuberance and denial that we saw in 1965 when stocks surged on optimism about the space race, consumer technology, and American industrial dominance. Looking at 1965 specifically provides insight into where we might be headed in 2025. After the recovery from the Cuban Missile Crisis in late 1962, the market entered a strong bull phase. By 1965, optimism was high, the economy was expanding, technology was advancing rapidly, consumer confidence was strong. The Dow Jones Industrial Average climbed steadily throughout the year, but beneath the surface, pressures were building. The Vietnam War was escalating, requiring increased government spending. Inflation was beginning to tick upward. The Federal Reserve was facing pressure to maintain easy monetary policy to support the expanding economy while also containing inflationary pressures. Market technicians studying long-term cycles note that 1965 marked a significant turning point. While stocks continued to climb, the character of the market changed, leadership shifted, volatility increased. The easy gains of the early 1960s gave way to a more challenging environment. By the end of the decade, these pressures would culminate in significant market turbulence. The 1960s bull market would eventually give way to the difficult markets of the 1970s. If the 60-year cycle holds, 2025 could mirror 1965 in important ways. After the recovery from the 2022 lows, markets have surged. Optimism about artificial intelligence has driven technology stocks to new highs. Economic growth has remained resilient despite higher interest rates. Consumer spending has held up better than many economists expected. But pressures are building beneath the surface. Government debt levels have reached historic highs. The Federal Reserve faces the challenge of bringing inflation back to target without triggering a recession. Geopolitical tensions continue to simmer. Trade policy debates create uncertainty for businesses. Several market strategists have noted these parallels and adjusted their outlooks accordingly. J.P. Morgan Research released forecasts in mid-2025, predicting weaker activity over the coming months combined with higher inflation prints in the U.S. They noted a 40% recession probability, which they described as not insignificant. Their analysis pointed to weaker growth ahead while inflation could squeeze purchasing power. Even with dramatic policy changes, they noted, the economic picture looked more challenging than most thought at the start of the year. Their year-end target for the S&P 500 was lowered to 6,000 from an earlier forecast of 6,500, reflecting the damage from uncertainty and potential payback from the front-loading of economic activity seen in the first half of the year. Other major financial institutions have echoed similar themes. Morgan Stanley Investment Management suggested that 2025 would be a pause year for the S&P 500, delivering single-digit gains along with greater volatility. This is consistent with the pattern that the third year of a bull market usually produces mediocre but still positive returns. Analysts at Charles Schwab noted that lack of economic data due to government shutdowns has added to confusion, keeping Treasury yields range-bound, while short-term interest rates fluctuate in response to shifting expectations about Federal Reserve policy direction. The parallel to 1965 isn't about predicting a crash. It's about recognizing where we are in the cycle. Just as 1965 wasn't the end of the bull market, but rather a transition point where the character of the market changed, 2025 may represent a similar inflection point. The easy gains may be behind us. The path forward could be more challenging, requiring greater selectivity and risk management. Gann's cycle work emphasized that understanding where you are in the cycle allows you to position appropriately. The first year of a decade, according to Gann, is the year to look for a bear campaign to end and a bull market to begin. The second year is a year of minor bull market or bear market rally. Year 3 is the start of bear year, but the rally from the second year may run into March or April. Year 4 is a bear year, but it ends the bear cycle and lays the foundation for a bull year. Year 5 is the bull year, the year of ascension. Year 6 is a bull year in which the bull campaign, which started in the fourth year, usually ends in the fall. Year 7 is a bear year. Year 8 is a bull year with prices starting to advance in the seventh year. Applying this framework, 2022 was the second year of the current decade, marked by decline that fits Gann's description of a Year 2 pattern. 2023 and 2024 showed the recovery and advance consistent with years 3 and 4. 2025 as Year 5 would be expected to be bullish, a year of ascension as Gann termed it. But his work also notes that Year 6, which would be 2026, often sees the bull campaign end in the fall. This creates an interesting setup where 2025 could deliver gains, but 2026 might mark a significant top. The decennial cycle, which examines patterns based on the year's final digit, also shows predictable tendencies. Research on this cycle found that years ending in 1 and 2 historically see bear market lows, with 1911, 1921, 1932, 1942, 1962, 1982, and 2002 all witnessing some of the most notable lows in the 20th century. Years ending in 3 and 4 are usually good for stocks with escalating prices, although some years buck the pattern. Years ending in 5 have been called the year of ascension, with virtually all years ended in 5 showing gains. Historical data supports this pattern. If an investor were out of the market at the beginning of years ending in 0, entered the S&P 500 on June 30th of years ending in 2, then were out from August through October of years ending in 7, and finally re-entered until the end of years ending in 9, research shows the value of $1 invested in 1900 would be worth $6,660.86 in 2002 versus just $148.41 if instead fully invested over the entire period. But cycles aren't destiny. They're tendencies based on recurring patterns of human behavior, policy responses, and economic dynamics. Markets can and do deviate from cycle predictions. The key is understanding that cycles provide context, not certainty. They tell you what's probable based on historical patterns, not what's guaranteed to happen. The current economic environment shows both similarities and differences to 1965. Similar to that period, we have strong economic growth meeting monetary policy tightening. Inflation concerns exist but appear to be moderating. Technology advancement is driving optimism and market leadership. Government spending is elevated. Geopolitical tensions create background uncertainty. But today's world also differs significantly. The economy is far more service-oriented and less manufacturing-dependent. Financial markets are more globally interconnected. Technology has advanced beyond anything imaginable in 1965. The scale of government debt relative to GDP is unprecedented. The demographic profile of the country has shifted dramatically. These differences matter because they affect how the cycle plays out. The core pattern may repeat, but the specific manifestations will be unique to our era. In 1965, the space race captured imaginations and drove technology investment. Today, it's artificial intelligence. In 1965, the Vietnam War was escalating. Today we have different but equally complex geopolitical challenges. The cycle rhymes but doesn't repeat exactly. Market analysts who study cycles emphasize that multiple cycles operate simultaneously, sometimes reinforcing each other, and sometimes working at cross purposes. The 60-year cycle is one framework among many. The presidential cycle suggests that markets tend to perform better in the 3rd and 4th years of presidential terms. The 4-year business cycle still operates. Shorter-term cycles of months and weeks continue to influence market movements. All these cycles interact, creating the complex patterns we observe in market behavior. The value of cycle analysis lies not in prediction, but in preparation. Understanding that 2025 sits at a similar point in the 60-year cycle as 1965 doesn't tell you exactly what will happen. But it does suggest certain dynamics are more likely than others. It tells you to be alert for shifts in market leadership. It suggests that the easy gains of the recovery phase may be giving way to a more selective environment. It warns that while markets can continue higher, the risks are rising and the margin for error is shrinking. Investors who understand cycles don't try to time the market perfectly. Instead, they position for the environment that's most likely based on where we are in the cycle. In the early stages of a cycle, when markets are recovering from lows, aggressive positioning makes sense. In the middle stages, when the trend is clearly established, following the trend works well. In the late stages, when the cycle is maturing, risk management becomes paramount. The 20-year cycle that Gann identified as one of the most important time cycles also provides perspective. This cycle, or 240 months, he noted, is one that most stocks and the averages work closer to than any other. The dramatic stock market lows of 1884, 1903, 1921, 1942, 1962, 1982, and 2002 all fit this 20-year pattern. The next low for this cycle was expected around 2022, which indeed marked the low point of the recent bear market. This alignment of multiple cycles, the 60-year cycle putting us in a position similar to 1965, the 20-year cycle marking a low in 2022, and the decennial cycle suggesting 2025 should be a strong year, creates a complex picture. The confluence of cycles can amplify movements in either direction. When multiple cycles align in the same direction, the resulting moves tend to be powerful. When cycles conflict, markets often become choppy and directionless. Research into why cycles work points to the combination of human psychology and structural economic factors. Human psychology follows predictable patterns. Greed and fear, optimism and pessimism cycle through populations in waves. When one generation experiences a crisis, they remember it and act cautiously. But their children, who only heard about the crisis secondhand, don't have the same emotional memory. By the time the grandchildren's generation takes power, the lessons have been completely forgotten and the same mistakes get repeated. Structural economic factors also operate in cycles. Debt levels build up over time, eventually reaching points where they must be reduced. This deleveraging process creates economic weakness, but it also clears the way for the next expansion. Monetary policy swings between accommodation and restriction as central banks respond to changing economic conditions. These policy cycles create recurring patterns in economic growth and inflation. The interaction between human psychology and structural factors creates the rhythm we observe in markets. In the early stages of a cycle, coming out of a crisis, both psychology and fundamentals support rising prices. Fear from the previous decline keeps valuation reasonable. Economic conditions are improving. Policy is accommodative. As the cycle matures, psychology shifts toward optimism and eventually euphoria. Fundamentals may still be strong, but valuations stretch. Policy begins to tighten. Eventually, something breaks. The cycle turns. Fear returns. Prices decline. The process begins again. Understanding this rhythm doesn't require believing in mystical forces or perfect mathematical precision. It simply requires recognizing that human nature is constant and that economic systems operate according to principles that create recurring patterns. Markets aren't random walks. They're the result of millions of people making decisions based on their hopes, fears, and rational calculations about the future. Because humans across generations tend to respond similarly to similar situations, patterns emerge. The 60-year cycle captures this generational dynamic particularly well. 60 years is long enough that the people who experienced the previous crisis are either deceased or very old. The new generation in power has no direct memory of what happened. They've read about it in history books, but they don't feel it in their bones. This creates the conditions for history to repeat. Not exactly, because circumstances have changed, but in broad strokes, because human nature hasn't. As we navigate 2025, the lessons from 1965 become increasingly relevant. That year saw markets continue higher, but the character of the advance changed. Breadth narrowed. Fewer stocks participated in the gains. Leadership concentrated in a smaller number of names. Volatility increased. These are all characteristics we're beginning to see in today's market. The Magnificent Seven technology stocks have dominated performance. Market breadth has been concerning at times. Volatility has picked up from the extremely low levels of the previous years. Market strategists note that in non-recessionary environments where the Fed is cutting rates, cyclical sectors have historically outperformed. Sectors like technology, financials, and consumer discretionary tend to rise and fall in tandem with the economy. Historically, in such environments, cyclical sectors have outperformed by 2 percentage points on average in the 12 months after the Fed started cutting rates. By contrast, defensive sectors like utilities, healthcare, and consumer staples have underperformed by 3 percentage points on average in such environments. This suggests that if the economy continues to grow and avoid recession, certain sectors should do well. but it also highlights the importance of being positioned correctly. A rising market doesn't lift all boats equally. In the mature stage of a cycle, selectivity matters enormously. The right sectors in the right market environment can deliver strong returns even as the broad market struggles. The bond market also provides signals about the cycle. In 2025, bond yields have remained elevated compared to the past decade. The 10-year U.S. Treasury yield has fluctuated around 4%. This is higher than the ultra-low rates of the 2010s but below the levels seen in previous decades. The yield curve, which had been inverted, has been steepening. Historically, yield curve inversions have preceded recessions, though the timing between inversion and recession has varied significantly. Interest rate policy remains a critical variable. The Federal Reserve faces a challenging balancing act. Inflation has come down from the peaks of 2022 but remains above the Fed's 2% target. The labor market has shown signs of softening but remains relatively healthy by historical standards. Economic growth has been resilient, exceeding expectations. This creates a situation where the Fed wants to ease policy to avoid unnecessary economic weakness, but they're also wary of easing too much and allowing inflation to reaccelerate. The parallel to the 1960s is instructive here as well. Throughout that decade, the Fed grappled with similar trade-offs. They wanted to support economic growth and employment, but also needed to contain inflation. At times, they got the balance right. At other times, their actions either squeezed the economy too hard or allowed inflation to build. The consequences of those policy choices played out over years, not months. The same will likely be true of policy decisions made today. Geopolitical factors add another layer of complexity. In 1965, the Vietnam War was escalating. Cold War tensions with the Soviet Union remained high. Regional conflicts created uncertainty. Today, we have different specific conflicts, but similar overall dynamics. Trade tensions between major powers create uncertainty. Regional conflicts in multiple parts of the world pose risks. The potential for miscalculation or escalation always exists. Markets generally handle geopolitical risk reasonably well, as long as conflicts don't expand dramatically or threaten global commerce directly. The housing market provides another parallel between 1965 and 2025. In the mid-1960s, housing was in good shape. Home ownership rates were rising, new construction was robust, mortgage rates were reasonable. Today's housing market has faced challenges. Affordability is near its worst levels on record, the result of sharp rises in home prices during the pandemic, followed by the rapid increase in mortgage rates as the Fed raised interest rates. Home sales contracted steeply in 2022, bounced modestly, then slipped back into contractionary territory. However, if the Fed's rate cuts translate into lower mortgage rates, it could revive the housing market, just as policy adjustments in the past eventually supported housing recoveries. Corporate earnings remain the fundamental driver of stock prices over time. In the short term, sentiment and liquidity dominate. But over quarters and years, earnings matter most. Analysts project double-digit earnings growth for the S&P 500 in 2026, with estimates around 12% year over year. This would provide support for further market gains if achieved. However, earnings forecasts are often overly optimistic. If actual earnings growth falls short of forecasts, stock prices could decline as markets price in the lower reality. The AI boom that has driven much of the recent market strength shows both promise and risk. Artificial intelligence represents genuine technological advancement with the potential to transform productivity across the economy. But the stock market tends to get ahead of reality in the early stages of new technology adoption. In the late 1990s, the internet was clearly going to be revolutionary, and it was. But that didn't prevent the stocks of internet companies from becoming wildly overvalued, leading to the severe bear market of 2000 through 2002. Today's AI leaders could deliver on their promise and still see their stocks decline if valuations have run too far ahead of near-term reality. Investor positioning also matters for how the cycle plays out. After the gains of 2023 and 2024, many investors have significant profits. This creates potential selling pressure if the market falters as investors move to lock in gains. On the other hand, there remains substantial cash on the sidelines that could fuel further advances if deployed. Surveys of investor sentiment show a mix of optimism and caution, neither the euphoria that marks market tops nor the despair that marks bottoms. The retail investor has played a significant role in recent market dynamics, similar to the democratization of stock ownership that occurred in the 1960s. Discount brokers, fractional shares, and easy access to markets through smartphone apps have brought millions of new investors into the market. This retail participation has added to volatility at times, but also provided support during declines. The staying power of retail investors through market cycles will be tested if we see sustained weakness. International markets add another dimension to the analysis. While the 60-year cycle framework primarily applies to U.S. markets, other regions show their own cyclical patterns. European markets face different demographics and policy challenges than the U.S. Asian markets, particularly China, are navigating their own economic transitions. Emerging markets offer different risk-return profiles. In 1965, international diversification was much less common for American investors. Today, it's standard practice. This global connectivity creates both opportunities and risks, as problems in one region can quickly spread to others. Currency markets also follow cyclical patterns. The U.S. dollar tends to strengthen during periods of global stress as investors seek safety. It weakens when global growth is strong and investors feel comfortable taking risk in other currencies. The dollar's path over the next several years will significantly impact U.S. multinationals, emerging markets, and commodity prices. A stronger dollar generally pressures commodities and emerging markets while benefiting U.S. consumers. A weaker dollar has the opposite effects. Commodity cycles operate independently of stock market cycles to some degree, but also show correlations at key turning points. The decades-long Kondratiev wave, which measures 46 to 60 years with a periodicity of 54 years, has been mapped in commodity prices, particularly wholesale prices, from the 1800s through today. The last trough in this commodity cycle was in 1940, with a prediction for a trough around 2000 that seemed correct. If this cycle proves accurate, we're now in the rising phase of commodity prices that could last decades. This has implications for inflation, monetary policy, and the relative performance of commodity-producing sectors and regions. Gold, often seen as an inflation hedge and store of value, tends to perform well in certain cycle environments. When real interest rates are negative, meaning nominal rates are below inflation, gold typically does well as it preserves purchasing power better than cash. When real rates are high, gold struggles as it pays no interest or dividend. In the mid-1960s, with inflation starting to rise and interest rates controlled, gold, though its price was officially fixed at that time, began to show pressure that would eventually lead to the breakdown of the Bretton Woods system in the 1970s. Today, with inflation uncertain and policy in flux, gold's behavior provides signals about market expectations for future monetary conditions. The cryptocurrency market adds a new element not present in 1965. Bitcoin and other digital assets have attracted significant investment flows. Their role in the financial system and how they perform through different cycle phases remains to be fully determined. The sharp decline in crypto prices during 2022 mirrored the stock market weakness. If the 60-year cycle thesis is correct and we're following a path similar to the mid to late 1960s, crypto assets will face their first test of how they perform through a full market cycle from peak through trough and back. Market structure has evolved significantly since 1965. High-frequency trading, algorithmic execution, passive index investing, and derivative markets all influence how prices move. These structural changes can amplify short-term volatility while possibly reducing the magnitude of longer-term moves as automated risk management systems kick in during stress. The flash crashes we've seen in recent years, where markets plunge then recover within minutes, were impossible in the manual trading environment of 1965. But the fundamental drivers of longer-term cycles, human psychology and economic dynamics, remain constant across these structural changes. Social media creates another difference from 1965 that affects how cycles play out. Information and sentiment spread instantly now. In 1965, investors learned about market news through newspapers, television, and phone calls. Today, a tweet can move markets in seconds. This acceleration of information flow can compress the timescale of sentiment shifts. The cycle stages that took months in 1965 might unfold in weeks today. But the underlying pattern of hope, greed, fear, and despair still cycles through, just potentially at a faster pace. The regulatory environment has also evolved. In 1965, markets were less regulated than today. The SEC existed, but its reach was more limited. Today's markets operate under extensive regulation designed to prevent fraud, ensure transparency, and reduce systemic risk. Whether this regulation smooths the cycle or simply changes how it manifests remains debated. Regulations can prevent certain types of excesses, but they can also create moral hazard if investors believe they're protected from losses, potentially leading to greater risk-taking. Pension systems and retirement accounts create a structural bid for equities that's much larger than in 1965. In the 1960s, defined benefit pensions were common, where companies promised specific retirement payments and managed the investments. Today, defined contribution plans like 401ks put investment decisions on individuals, and these accounts automatically funnel money into stock and bond markets with every paycheck. This creates steady demand that can support markets through cycle downturns, though it also means that market declines directly impact retirement security for millions of people. As we consider what comes next in 2025 and beyond, the 60-year cycle framework suggests we're at a transition point. The recovery phase from the 2022 lows has played out. Markets have rebounded sharply. Optimism has returned, though not to extremes. The easy gains are likely behind us. What comes next will require more careful navigation. If the pattern holds, the next 12 to 18 months could see continued gains, but with increasing volatility and shifts in leadership. By late 2026 or early 2027, roughly mirroring the late 1960s, we might see more substantial challenges emerge. This doesn't mean selling everything and hiding in cash. Market timing is extraordinarily difficult, and the cost of being out of the market during strong advances often exceeds the benefit of avoiding declines. But it does suggest adjusting risk levels appropriately, taking some profits after the strong run, ensuring portfolio diversification across sectors and asset classes, maintaining adequate cash reserves for opportunities that emerge during volatility, being selective about new investments rather than buying anything that's going up. These risk management principles become more important as cycles mature. The 60-year cycle also reminds us that major opportunities emerge from market dislocations. 1962 marked an excellent entry point for long-term investors. Those who bought during the Kennedy slide and held through the subsequent decade did extremely well despite the challenges that emerged later in the 1960s and 70s. Similarly, investors who bought during the 2022 decline have already seen substantial returns. If the cycle brings another dislocation in the next few years, it will likely create another excellent long-term entry point. Understanding cycles provides perspective that's invaluable during market turbulence. When markets fall and fear rises, cycle analysis reminds you that declines are normal parts of a recurring pattern, not the end of the world. When markets surge and euphoria builds, cycles remind you that nothing goes up forever and that risks rise as prices extend. This perspective helps avoid the emotional extremes that cause investors to buy high and sell low, the pattern that destroys wealth over time. The human tendency is to extrapolate current conditions indefinitely into the future. When markets are strong, we assume they'll stay strong. When markets are weak, we assume they'll stay weak. Cycle analysis forces us to recognize that conditions change, that strength leads to excess that eventually creates weakness, and that weakness eventually clears the ground for the next advance. This counter-cyclical mindset is uncomfortable because it requires going against the crowd, but it's essential for long-term investment success. As this script comes to a close, remember that the 60-year cycle isn't a crystal ball. It doesn't tell you exactly what will happen next week or next month, but it does provide a framework for understanding where we are in the longer-term rhythm of markets. It tells us that 2025 sits at a similar point in the cycle as 1965, after a sharp decline and recovery, with the question being whether the advance continues or whether we're approaching a transition to a more challenging phase. The patterns of human behavior that created the cycles of the past continue to operate today, even as the specific circumstances differ. By understanding these patterns, by recognizing where we are in the cycle, you can position yourself to navigate whatever comes next with greater confidence and less emotion. If you found this exploration of the 60-year cycle valuable, if you now see patterns in market history that you didn't recognize before, like this video and subscribe to the channel. The cycles continue to turn, the patterns continue to repeat, and understanding them gives you an edge that most investors never develop. History doesn't repeat exactly, but it rhymes with remarkable consistency for those who know the patterns to watch.